Banking conditions in the Ninth Federal Reserve Bank District were mixed with weak profits but strong loan growth. Hi, my name is Ron Feldman. I'm the Executive Vice President of Supervision, Regulation, and Credit at the Federal Reserve Bank of Minneapolis. And I'm going to be talking about banking conditions in the Ninth Federal Reserve District as of the third quarter of 2013. Before I get started, let me remind you what's in the Ninth District. We've got the states of Montana, North and South Dakota, Minnesota, the western portion of Wisconsin, and the upper peninsula of Michigan. And as you can see from this slide, we've got a lot more data on banking conditions that I'm going to cover today, and I would encourage you to take a look. The main story for conditions in the third quarter was a bit mixed. We had very strong loan growth, and we had improvements in problem loans, that is a decline in problem loans, but we also had flat profitability, and that profitability remains considerably below historical norms. We've also seen some improvement in the ratings that bank supervisors give banks, and I'll describe that in a bit. In terms of what we've seen in the individual states in the district, generally speaking, it's going to mirror the story I just told you, where you've got some improvement in loan growth, some decline in problem loans, but relatively flat profitability. So let me walk through those three parts of banking performance in a little bit more detail. And I'm going to start with asset quality, or problem loans. So a problem loan is a loan that's not paying on time or in full. And as you can see from this graph, the amount of problem loans for the median bank in the district is falling, and it continues to be considerably below the 20-year median. So that is relative to the historical norm. Problem loans today are much lower than what they are typically. Now, one kind of measure of problem loans is in what's called OREO. That's the other real estate owned by banks. So a bank would get possession of real estate, for example, when one of its borrowers is not paying on time and in full, and the collateral, the real estate that the firm provided to the bank, gets seized. And you can see that normally this amount of what's called, again, OREO is very low. It rose considerably during the financial crisis as firms were unable to repay their debts and collateral was seized. And I want to show you that this is starting to fall. And we can see that in several quarters, maybe even a year, we're going to be back down to a level that's more historically normal. And this is really the last measure of problem loans that remains high. Now let's turn to profitability. Here the story is not so bright. Profitability was generally flat, and you can see that as opposed to problem loans, which are below the historical norm, here you can see that profitability has yet to reach the historical norm. And as the fact that we had a flat quarter implies that it's going to be even longer before banks get back to the norm. So why is this? It's frankly because of the low interest rate environment in which we're in. Banks are earning less on the loans that they're making, which is their primary source of earnings. They're also paying less to get the funds to make those loans, but the difference between the amount that they're earning and the amount that they're paying is fairly compressed, so they're having a hard time earning profits. Loan growth was more positive. There was pretty strong loan growth. Like profits, we remain further away from the historical norm than we do with problem loans, but at least problem loans are moving in the right directions. And in fact, as you see in the next graph, about 2/3 of all the banks in the district actually have positive loan growth. So let me summarize the conditions of the banks. Again, problem loans, not really a problem for the typical bank. Loan growth positive, but still far away from the historical norm, and profitability flat in the third quarter and still off the historical norm. I'm going to move to supervisory ratings now. So recall that supervisory ratings range from 1 to 5. 1 is a very strong bank, and 5 is a bank that supervisors believe are going to fail. Right now, about a fifth of the bank, or 20%, are rated 3, 4, or 5. Those are banks that are considered to be less than satisfactory condition. So 1 out of 5 banks is still quite a few, but you can see from the graph that it's down considerably from when it was closer to a third of the banks. And my expectation is that this is going to improve quarter by quarter. Finally, what kind of variation are we seeing across states in the district? I'm going to show you profitability because that's the area where I think banks still face the greatest challenge. And you can see that there's quite a range. We have states like North Dakota, where the median bank is improving its profitability already to a strong level. And then we've got states like the western portion of Wisconsin and the upper peninsula of Michigan, where there was actually a decline in profitability. So there's a wide range, but generally speaking, what you're going to see in this graph is that most of the banks had relatively small gains or flat profitability, consistent with the district as a whole. So third quarter was a mixed bag. We'll see where we stand for the year as a whole next time that I bring you a summary of conditions in about a quarter. Thank you.